This is Financial Entropy, and today we're investigating the systemic decay of the exchange rate mechanism. On the morning of September 16, 1992, the Bank of England raised interest rates twice before lunch. By evening, Britain had withdrawn from the European monetary system. The government's loss exceeded £3 billion in a single day. This was not a bank run. This was not a credit crisis. This was something else. The official explanation emphasizes external speculation. The internal documents reveal a different pattern. For 18 months before that Wednesday, the British government had maintained a currency peg it could not afford to defend. The markets knew, the Treasury knew, the commitment remained absolute. Here is the mystery we will resolve by the end of this investigation. Why does a rational institution continue defending a position long after the cost of defense exceeds the cost of retreat? The answer is not in the decision made that September morning. It is in the architecture of constraints built years earlier when the peg itself was chosen. Part 1. The Brittle Peg. On October 8, 1990, Britain entered the exchange rate mechanism at a central rate of 2.95 Deutschmarks to the pound. According to the 1991 Treasury Select Committee report, page 47, this rate was approximately 15% above the level recommended by the Bank of England's economic staff. The Chancellor overruled the technical assessment. The political priority was European monetary integration. The economic cost was deferred. The exchange rate mechanism was designed as a stability corridor. Member currencies could fluctuate within narrow bands against the Deutschmark. If a currency approached the edge of its permitted range, the central bank was obligated to intervene. The mechanism assumed that intervention would be temporary, capital flows would adjust, speculators would retreat, equilibrium would return. This assumption required three conditions. First, that member economies moved in synchronized cycles. Second, that capital controls could limit the volume of speculative pressure. Third, that central bank reserves were sufficient to outlast any attack. By 1992, all three conditions had eroded. Germany had reunified in October 1990. The fiscal cost of integrating East Germany drove the Bundesbank to raise interest rates throughout 1991 and into 1992. According to the Bundesbank monthly report of July 1992, page 18, the discount rate reached 8.75% by mid-year. This was a contractionary policy designed for German inflation. It was transmitted automatically to every currency pegged to the Deutschmark. Britain was in recession. According to the Office for National Statistics quarterly bulletin of October 1992, page 6, GDP had contracted for 5 consecutive quarters. Unemployment had risen from 1.6 million in 1990 to 2.7 million by August 1992. The rational domestic policy was monetary easing. The exchange rate mechanism required monetary tightening. The peg imposed German monetary conditions on a British recession. This created the first measurable escalation. To defend the pound's lower band, the Bank of England had to match or exceed German interest rates while the domestic economy contracted. The base rate stood at 10% in August 1992. This was not a policy chosen for British conditions. It was a policy imported from Frankfurt. Here is the incentive structure that made retreat irrational. The government had staked its European credibility on ERM membership. The Prime Minister had described the peg as the cornerstone of anti-inflation policy. Withdrawal would signal policy failure, political weakness, and economic instability. The reputational cost of exit appeared infinite. The financial cost of defense appeared manageable. This is the logic that traps institutions. The longer the commitment is maintained, the greater the reputational investment. The greater the investment, the higher the cost of admitting error. Defense becomes compulsory not because it is affordable, but because retreat has been ruled out. The second destabilizing force was capital mobility. Throughout the 1980s, European governments had dismantled capital controls to facilitate cross-border investment. According to the Bank for International Settlements annual report of 1992, page 103, daily foreign exchange turnover in London exceeded $300 billion by 1992. This was 30 times Britain's official reserves. The removal of capital controls had shifted the balance of power. Central banks could no longer gate the flow. They could only respond to it. The third force was visible information asymmetry. Currency traders had access to the same data as policymakers. They could observe the divergence between British economic conditions and the interest rates required to defend the peg. They could calculate the scale of intervention needed to hold the band. They could see the reserves. According to the Bank of England's quarterly bulletin of November 1992, page 388, Britain's foreign exchange reserves stood at $44 billion in early September. This sounds substantial until measured against daily market turnover. A coordinated selling wave could drain those reserves in hours, not weeks. The anchor thesis governing this investigation is as follows. The collapse of September 16, 1992, was not caused by irrational speculation. It was caused by a structural mismatch between the political commitment to a fixed exchange rate and the financial capacity to defend it against rational profit-seeking behavior in a liberalized capital market. Every participant acted logically within their constraints. The government defended the peg because withdrawal meant political humiliation. The Bundesbank raised rates because German inflation required it. The currency traders sold sterling because the probability of devaluation exceeded the cost of holding short positions. No individual decision was irrational. The system itself was unstable. Part 2. The terminal anomaly. Through the summer of 1992, the pressure built incrementally. The pound drifted toward the bottom of its band. The Bank of England intervened repeatedly, buying sterling and selling foreign currency to prevent a breach. According to the Treasury's economic briefing of August 1992, page 12, intervention totaled $9.8 billion in August alone. The reserves were depleting. The Bundesbank offered no assistance. German domestic priorities dominated. On August 26, 1992, Bundesbank President Helmut Schlesinger stated in an interview with Handelsblatt that several currencies might need to realign. The statement was coded but clear. The Bundesbank would not subordinate German monetary policy to defend other members' pegs. Currency traders interpreted this as authorization. If the Bundesbank would not defend the system was vulnerable. Short positions against the pound accelerated. According to a 1993 analysis by the International Monetary Fund working paper 93/71, page 14, hedge funds and proprietary trading desks had accumulated short sterling positions exceeding £15 billion by early September. Here was the escalation. The market was no longer testing the peg, it was pricing in its collapse. The forward markets showed a widening discount. Options markets showed spiking volatility. The visible expectation of devaluation became self-reinforcing. Every trader who shorted the pound increased the intervention burden for the Bank of England. The government's response was to double the commitment. On September 3rd, the Treasury announced that Britain would borrow £7.25 billion in foreign currency to bolster reserves. On September 4th, the Prime Minister stated publicly that devaluation would be a betrayal of Britain's economic strategy. The rhetoric escalated in proportion to the vulnerability. This is the trap of signaling in asymmetric warfare. The stronger the verbal commitment, the greater the reputational cost of failure. The greater the cost of failure, the more necessary it becomes to defend at any price. The government was no longer defending an exchange rate, it was defending the credibility of its word. By September 10th, the Italian lira had breached its floor. Italy devalued by 7% within the mechanism rather than abandon it entirely. This was supposed to relieve pressure on other currencies. It had the opposite effect. Devaluation proved that the bands were not inviolable. If Italy could adjust, so could Britain. The precedent weakened the entire structure. The following analysis is based on available public records and the limited perspective of institutional archives. On the weekend of September 12 and 13, European finance ministers met in Bath. According to the minutes released in 2005 under the 30-year rule, the British Chancellor pressed for a coordinated interest rate cut to relieve recessionary pressure across the ERM. The Germans refused. The Bundesbank's mandate was price stability. German inflation was 3.5%. A rate cut was unacceptable. The meeting ended without resolution. Currency markets opened Monday morning with clarity. There would be no policy coordination. Britain was isolated. The Bank of England intervened heavily on Monday and Tuesday. According to the Quarterly Bulletin of November 1992, page 391, the bank spent over $10 billion defending the pound on September 14 and 15 alone. The reserves were visibly draining. Every trader with access to a terminal could see it. On the morning of Wednesday, September 16, the pound opened at 2.7985 Deutschmarks, just above the lower ERM band of 2.778. The Bank of England began buying sterling immediately. According to Norman Lamont's 1999 memoir, In Office, page 246, the bank spent £2.8 billion in the first hour of trading. The selling pressure absorbed the intervention without slowing. At 10:30 a.m., the government raised the base rate from 10% to 12%. The announcement was intended as a shock. Higher rates would attract capital inflows and punish short sellers. The market response was immediate indifference. Sterling continued falling. If you're finding this analysis of market disorder valuable, subscribe to Financial Entropy for more investigative deep dives. Here is where the mechanics of the siege became visible. The traders were not betting on economic fundamentals, they were betting on exhaustion. The question was not whether Britain could defend the peg on Wednesday morning. The question was whether Britain could defend it on Thursday and Friday and the week after. The reserves were finite. The market's capacity to sell sterling was effectively infinite. At 2 p.m., the government announced a second rate increase from 12% to 15%. This was no longer economic policy. This was desperation theater. A 15% interest rate would have crushed the housing market and forced widespread corporate bankruptcies. According to the 1993 Treasury Report on the ERM crisis, page 28, the second increase was never intended to take effect. It was a signal of absolute commitment, hoping psychological deterrence would succeed where financial intervention had failed. The market called the bluff. Sterling continued to fall, the reserves continued to drain. According to Eddie George's 2003 testimony to the Treasury Select Committee, the governor of the Bank of England informed the chancellor shortly after 3 p.m. that the reserves were nearly exhausted. The bank could no longer defend the band. The options were devaluation within the ERM or withdrawal entirely. At 7:30 p.m., the chancellor appeared outside the Treasury and announced that Britain was suspending its membership in the exchange rate mechanism. The base rate would return to 10%. The pound would float. The 18-month defense was over. The cost was calculated in the months that followed. According to the National Audit Office report of December 1992, direct intervention losses totaled £3.14 billion. The true cost was larger. The government had spent political capital, institutional credibility, and 2 years of restrictive monetary policy defending an unsustainable position. The anchor thesis holds, this was not irrational speculation defeating rational policy. This was rational speculation exploiting the structural contradiction between a political commitment and a financial constraint. The traders were not villains. They were arbitrageurs. They identified a mispriced asset, a currency pegged above its sustainable level with insufficient reserves to defend it indefinitely. The profit opportunity was visible. The risk was limited. The government had announced it would not devalue. Therefore, the downside of shorting sterling was capped while the upside was open. This is not gambling. This is probability-weighted return. The modern relevance is direct. Central banks today manage the same contradiction. They defend asset prices, currency stability, and inflation targets simultaneously. They signal absolute commitment to policy frameworks while operating with finite balance sheets in liberalized capital markets where daily turnover dwarfs their reserves. The lesson of Black Wednesday is not that speculation is dangerous, it is that finite resources cannot defend infinite commitments when the commitment itself is structurally unsustainable. In 1992, the contradiction was visible in currency markets. Today, it appears in sovereign debt markets, where central banks must choose between price stability and debt sustainability. It appears in asset markets, where quantitative easing has tied monetary policy to equity valuations. It appears in banking systems, where implicit guarantees exceed explicit capital. The pattern is identical. A public institution makes a commitment that appears credible until stress reveals the resource constraint. The market tests the constraint. The institution escalates its defense. The cost of defense rises until it exceeds the benefit. Collapse is not triggered by panic, it is triggered by arithmetic. The observable systemic risk signal today is the divergence between central bank policy commitments and balance sheet capacity relative to market size. In 1992, the Bank of England's reserves were 1/30th of daily forex turnover. In 2024, according to the Bank for International Settlements quarterly review of December, global central bank assets total approximately $36 trillion, while daily turnover in foreign exchange, interest rate derivatives, and equity markets exceeds $25 trillion. The leverage has not decreased, it has scaled. The defensive awareness behavior is to observe not what institutions say, but what their balance sheets can sustain. When a central bank announces a policy floor in asset prices or a ceiling in yields, the question is not whether they are committed. The question is how long they can fund that commitment against a market that disagrees. The siege of 1992 demonstrated that market entropy defeats institutional commitment when the resources required for defense exceed the resources available. This is not a historical anomaly. It is a recursive feature of any system where political objectives are funded by finite capital in liberalized markets. The pound floated freely after September 16. Within 2 years, Britain's economy had recovered. Interest rates fell, growth returned. The catastrophe predicted by withdrawal never materialized. The defense itself had been the damage. Here is the final recontextualization. The Bank of England did not lose the battle on September 16. It lost the battle on October 8, 1990, when it entered the ERM at an unsustainable rate with insufficient tools to defend it. The intervening 18 months were not a defense. They were a demonstration of the time it takes for a structural imbalance to express itself in price.
At Financial Entropy, we analyze historical patterns to understand modern risks. Hit the bell to track the disorder with us.